And we're talking about interest rates and the impact that they have on the markets. And there's this perception that if interest rates go up, the markets go down, and if interest rates go down, the markets go up, which is obviously just a complete, utter rubbish piece of information. Nobody thinks that in the world of professional trading. But for some reason, a lot of retail traders think that that's what happens. And it's not that's what happens at all. We did do a classroom in detail about this whole concept a while ago, and we says don't be stupid enough to fall for that idea that just because interest rates are going up that the markets will go down, because obviously history shows that generally interest rates go up, the market goes up. Generally, when interest rates go down, the market goes up. So the market goes up because of the inflationary elements of the markets. And interest rates isn't about whether the market goes up or down. It's about the impact the interest rates have in long-term forecasts. In other words, when we look at interest rates, we don't just look at the short-term part of the curve. In other words, the Fed line. What we look at is the impact it has at the back end of the curve, because that's where longer term investments are analysed. That's where longer term investments are planned and executed. And if we can see that the back end of the curve is not in play, equities will not be in play, because people buy equities for long term buy and holds. So in other words, they're not going to buy equities if long term investments aren't in play. They're going to buy short term investments. They're going to buy short term speculations. And obviously, what happens a lot of time in short term is that they will buy options and sell options, not products, underlying products. Why? Because options benefit from short-term view of the marketplaces. And that's when gamma gets created. Because obviously, if you've got options and you're playing in the options short term and you're trading this concept of theta decay, then obviously you're trying to get fast money impacts from your options. Fast money impacts mean that you make a lot of monies. You get a lot of good hedging quality. So when we're looking at things like interest rates, for example, this is the two stands here. And a lot of people will look at the two stands and say, I thought when the two stands rallied, we see selling, and when the two stands falls, we see buying. And it's just not true. It's never been true. But obviously you might say, but when the two stands rallied here, we did get a big sell. When the two stands rallied here, we got a big sell coming in. Yeah, you're right. But that's not the reason. That is not the reason. Because we've had a big rally in the two stands here and we've been able to buy bottom edges. So how do you explain that unless you simply just make stuff up on the right-hand edge? The truth is that we know what the market is doing at the back end of the curve by analysing the front end and the back end of the curve. So when we look at, for example, the back end of the curve versus the front end of the curve, this is what it looks like. We can see that when the two stands is rallying here, you can actually see that the back end of the curve during the same period actually is also going up, which is quite healthy. It's a healthy trade outcome, and you can see during that same period that equities were able to trade quite nicely to the upside, even at session swing highs or historical highs. You can see equities continue to trade nicely to the upside during that entire period there of about 2 weeks. When did it start becoming problematic? It started to become problematic when you started to see the back end of the curve really suffering as the interest rates continued to pile on at the top edge. There needs to be a correction. One might imagine there needs to be a correction in short-term interest rates or a correction in equities. Well, it's not going to happen in short-term interest rates. A correction in short-term interest rates may happen by the Fed, but it's unlikely to happen unless there's a real calamitous outcome. So at this stage here, I'm now prepared, I'm now ready, I'm now looking for a possible short sell because of this impact it's having. And sure enough, the sell comes in, because a lot of people think you just cherry pick this sell here and say, but what about these days here when interest rates were rising? And they just don't get it. They don't understand it. And it's not just about this as well. It's about what the volatility looks like. Are they actually pricing in a possible short sell? Are we starting to see the possibility that the gamma is starting to build? And if the gamma is starting to build, are we expecting to see a slippy but downside marketplace? These are the things that we start analysing as a group. These are the things we start analysing when we start looking at whether the activists are selling, whether the volatility pricing is getting more expensive, whether the gamma pricing is getting more expensive, whether the rotations are starting to show up as defensive rotations. But all I'm now looking at is the interest rate curve. As the interest rate curve here really struggles with this higher pop, I am only going to be looking to sell day highs. And that's not a difficult case to look at, because obviously all you're going to do is draw the day set, the prior day highs. That's why we do prior day highs. So when you draw in prior day highs, you're starting to draw lines across your chart and you're saying, if I go above those prior day highs, I think I should be selling this. You'll probably see from a lot of my tweets, I'll say I am no longer buying day highs. It doesn't necessarily mean I'm going to be selling, because I would need to see additional proof of that selling. But the idea is, if I'm no longer buying day highs, this is what we're talking about. I no longer want to participate in this day high narrative. It's not for me. In other words, it's more likely to be a sell when we start giving out things like care warnings, when the volatility starts to agree with the situation that we're seeing in terms of things like interest rate curves. So you can see that during this second period here, where interest rates are still going higher, you can see we're not seeing the same impact on the back end of the curve here. The back end of the curve, in fact, is actually relatively supportive at lower prices. I'm not saying it's great for any, there's no way that we could look at that and say, oh, it's absolutely brilliant. But it's definitely not as bad as it was when the big drop took place during here, right? When we got that very, very big drop in the curve. Certainly not as bad as that. So we can buy discounts into these areas. I still think it's problematic, because if the rate curve is as flat as this, then we're talking about a situation that you're looking at. If the equity starts selling and this is low, then you're imagining that probably what's going to start happening is what you're hoping is going to start happening is you're going to start seeing short-term interest rates starting to turn round here. As we see short-term interest rates starting to flatten here, then of course that's going to be supportive for equities, so long as we start seeing the back end of the curve responding positively to a fall that's taking place. Because you might be looking at this and saying, we had a situation here, for example. So we had this rally here, and we had the rally in short-term interest rates, and we had a very, very negative impact on the back end of the curve. Do you see it? So if we had a very negative impact on the back end of the curve there, you'd say, well, this is a big short. So obviously what happens is it stays a big short even on a day like this. You're saying, well, I'm not going to be buying day highs, that's for sure. And then you get a big sell-off coming in. And as soon as you got that big sell-off, you saw the big drop in interest rates here. Well, when you saw a big drop in interest rates, a lot of people would start saying to themselves, I should now be looking at getting into a buy trade here. Well, that would be a mistake, because we're not seeing any type of positive impact at all on the curve. So what we're really looking for is that price to keep staying on that discount sell. We saw another big impact on the sell side here on that update. You see the back end of the curve dropping hard here on a very small rally in interest rates. Do you see that? On a very small rally in interest rates here, we're getting a very negative impact on the curve. So you're obviously going to be looking at those types of days and saying, well, realistically, I should be thinking about top edge sells. So where are we just now? Relatively constructive at lower prices. We would like to see the front-end interest rate starting to peel off a little bit to give us a little bit more upside in the back end of the curve here. So we're hoping that that would then accelerate the upside. We would see a bit more buying at lower prices. It'd be a little bit more supportive, because now people aren't as short-term. They're now a little bit more long-term, which means if people are longer-term, they're more likely to buy stocks rather than holding their money in cash. They're more likely to buy stocks. They're more likely to rotate out of bonds. Why are they more likely to rotate out of bonds? Because interest rates are falling. They're not getting as good a deal on bonds, so they might as well buy discounted stocks when that takes place, right? It's called risk premium. If you've got a good discount to risk premium, then it's a good opportunity to buy stocks and sell bonds into that discount. So this is good news, isn't it? This is very, very good news at the moment, because this is stable. So therefore, buying dips does have an opportunity to be in play. Now, one of the things we add to this, of course, is we start looking at this in relation to things like gamma. When we look at realized volatility, rather than future volatility, this is a very stable storyline. And obviously, the simple basic idea is that when we're looking for this sell side picture, what we're looking for is a rise in realized volatilities. And we get it just here. We start seeing realized volatility starting to rise here. If we're starting to see volatility starting to rise here, you can see it for yourself, then obviously that means that we're starting to look at that separation here, and volatilities are starting to work on the opposite side. This market is getting very bearish. Care warnings should now be in place for your market. You should be short selling this. That would have put you into one of the biggest sell-offs we've had for a while, right? It was a brilliant, massive, multi-$1,000 sell-off on one day. And you had 5 days notice of it by simply following this process. 5 days notice to try and take advantage of all the pieces of the jigsaw puzzle that were taking place in those areas. Crazy. But obviously, again, looking at the background to this, we can see that realized volatilities have actually came down quite a lot. Now, they're holding quite high at the moment. So that's my biggest concern, is they are still holding quite high overall. But you can see that they are declining somewhat here, giving you this idea that if they're declining and they've gone lower than they've been at any stage during here, well, equities have the opportunity potentially to go all the way back towards the 6,000 here, haven't they? The way that that would become an absolute given is if we start seeing some sell pressure coming into the front end of the curve, when we start seeing an acceleration on the back end of the curve. The story for that macro long position would be absolutely fabulous. But this is what we're looking for, right? We're trying to build this picture at the end of each day. This is what we call the lifestyle trades, where you're trying to trade, for example, the end of day RGLs. These are the kind of things that we want to try and see. End of day RGL type stories, end of day type narratives. But you've got to be able to recognize it, you've got to be able to play it, you've got to be able to read it out, you've got to be clear about what you're seeing. Anyway, I'm going to grab some lunch, guys. I'm going to grab some lunch. Oil did sell off. We were sold the 75s a few times. It's now dropped down to 50s. I'm quite happy with that. I'm not ecstatic about it, but I'm quite happy with that outcome. And yeah, nothing wrong with it. I'd been